Hello everyone, my name is Kevin Carlson. I'm a mortgage broker here in Canada. Thank you so much for joining me on my channel to learn a little bit more about mortgage financing. So since you clicked on this video, you probably have heard about the mortgage stress test and wondering what it is and what it means. Well, it's actually been around for quite some time. Since 2013, it was brought in kind of a watered down form of what it is today. And then since then, it's become a little bit more difficult to deal with year over year with some of the changes that have been brought in. The mortgage stress test is what the Canadian federal government is doing to help protect Canadians from rising interest rates down the road. Ever since the stress test has been brought in, the mortgage and real estate industries have been lobbying the Canadian federal government to ease the stress test, if not eliminate it, and that really hasn't happened. On February 18th of 2020, the federal government announced that there would be some tweaking done to the stress test rules and guidelines and making things a little bit easier. And when I say a little bit, I'm stressing that. It is a little bit. It is not very much better, but any little bit of a change will certainly help, and it is welcome. So let's go over stress testing and the mortgage stress test and what it actually means and how it affects people applying for their mortgages. I did a previous video on the changes in the mortgage industry over the last 15 years. I describe in quite a bit of detail as to what has happened in the mortgage industry in that time and kind of how the stress test was born and how it's changed over the years. Have a look at that video. There's quite a bit of information there, and I will link to it in the description below. So the mortgage industry is actually regulated by the Canadian federal government, by the Office of the Superintendent of Financial Institutions. It is their mandate to regulate the mortgage industry that we do not give Canadians more of a mortgage than they can actually afford and potentially causing financial ruin. So the rules and guidelines that are set out by the federal government are around debt service ratio calculations. These debt calculations ensure that a particular applicant, whether it's a single person or a couple or more, can afford the mortgage payments. So what we do is we take your gross household income, so that's your income before income taxes, and take that as a ratio up against your current debt, so lines of credit, credit cards, and loans, up against the mortgage and taxes on the house you're just about to purchase. The maximum ratio that I have to keep a client within is no more than 40%, or 44% if your credit is excellent. So let's take some easy numbers here. Let's say we have a family that is earning $120,000 a year of gross income. So divide that up into 12, so that's $10,000 per month that they have available of gross income. So once you add up all their monthly payments on loans, credit cards, anything like that, car loans, and the potential mortgage and taxes on the house that they're about to purchase, they cannot spend more than $4,000 per month in all of those payments combined, or $4,400 for excellent credit. If you're going to be doing some math on your own, on figuring out how much your debt service ratio calculations are, there's a few things you need to keep in mind when it comes to underwriting practices. If you have a credit card or a line of credit, the payment that we are required to use in your debt service ratio calculations are 3% of the outstanding balance on that credit item, not the minimum payment. Very often the minimum payment is significantly less than 3% of the balance. If you pay child or spousal support, those payments are counted against you in your debt service ratio calculations, just as if it was a regular loan payment. For those of you that have rental properties, we can't just take 100% of your rental income and just put it on top of your regular salaried or hourly income to offset any mortgage and tax payments on rental properties. We have additional calculators we have to use that are much more complicated, and every bank is a little bit different. If you have student debt where you're still in school or you're not required to make the payments or you're on some sort of a payment relief, I still need to use some sort of an estimated payment on student loan debt. Even though you're not required to make the payments, you eventually will be, and the lender's going to want to see that you can afford to make those payments as well. Anytime I'm working with a client to approve their next mortgage, I have to keep a keen eye on those debt service ratio calculations. If they fall outside of the regular guidelines, then I can't even send it away to a lender for mortgage approval. The stress test is actually built on how much is the client going to be paying on the mortgage that they're applying for. Before mortgage stress testing came in, anybody who was applying for a mortgage through me, I was able to use the payment they were actually going to be making on the mortgage based on the interest rate that I got for them. over the last 4 or 5 years, we've seen 5-year fixed rate mortgages well below 3% for the most part. If you look at a 30-year trend of 5-year fixed rates here in Canada, then you'll realize that that 3% rate and below is a significantly low rate. Keep in mind that a 5-year fixed rate mortgage is fixed. It will not change for that 5-year term. So if a client takes a 5-year fixed rate mortgage and then rates are moving around during those 5 years, they're insulated and protected from those increases. Their payment and their interest rate stays the same for that full 5 years. So that's very much what the Canadian federal government was concerned about and how the stress test came to be. They were worried that Canadians that were taking these very low interest rate mortgages, well below 3%, that at the end of their term that they can't afford the payments if rates had gone sky high. So when I work with clients after stress testing under those new rules and guidelines, not only can I get them just as good a rate as what we've been getting over the last few years, but they must demonstrate that they can make the mortgage payments at that higher stress test rate. So as of today, the stress test rate is 5.19%. 5.19 is almost 2.5% higher than we're actually getting for our clients right now. So now on to the changes that we're going to be coming in on April the 6th of 2020. So the stress test rate is not going to be adjusted just maybe once or twice a year. It's going to be adjusted every week. The adjustment factor is going to be 2% above what typical clients are getting for 5-year fixed rates. So in that example, then we might see maybe a 0.5% savings on the stress test. So rather than 5.19, it'll be well under 5 for the pre-approval. Now, what does that mean for the typical home buyer? Well, probably not a whole bunch. It will probably just buy a little bit of wiggle room. Anytime somebody gets pre-approved for a certain amount, sometimes the taxes come in a bit higher or the purchase price gets negotiated a little bit higher, and we kind of sometimes need that wiggle room. I'm sure anybody like myself in the mortgage industry will still be sticking to that higher benchmark when we go out to pre-approve somebody to go out and purchase a house, because the stress test rate is going to be changing weekly. So it could be somebody that we pre-approve for the purchase of a house now, but then 3 months down the road they end up finding one and the stress test rates changed multiple times and they might not be pre-approved for that house. So here's a few tips and tricks on battling that stress test rate and ensuring that you're able to get approved for the mortgage that you're looking for. The very first thing that I can recommend, if you're looking to buy a car and a house, buy the house first. The auto financing industry does not have these same rules and guidelines. You can pretty much always get a car loan as long as your credit is excellent. The second thing is pay down as much debt as you can and don't go out and finance extra things. Carrying more debt, having more payments, those things just eat into your debt service ratios and reduce the amount of mortgage that you're able to qualify for. That's about it for this video on mortgage stress testing. If you have any questions or comments, please feel free to use the comment section below and I try to answer those as soon as possible. If this is not one of the very first videos of mine that you've watched, you might want to consider subscribing to my channel to be notified when additional videos come out. If you enjoyed this video and you found a bit of value, give it a thumbs up and maybe even share it to others that might benefit from some of this education. If you live in Canada and you're looking to purchase a home or you're looking for some mortgage financing, I would very much enjoy working with you. Please contact me through my website below, which I'll link in the description. Thank you so much for your time and have a great day.